Welcome to our Samvat special. Our guest today is Neelkanth Mishra, Managing Director, Co-Head Asia Pacific Strategy and India Equity Strategist for Credit Suisse. Actually, no one understands economy and policy and markets and their confluence as well as Neelkanth does. So thank you very much, Neelkanth, for joining us. Have a great Samvats 2079 yourself.
Thank you, Lata. Thank you for those kind words, and very happy Diwali to you and your team as well.
Thank you. Well, Neelkanth, actually, I'm going to ask you a very stale question, perhaps. We know as market anchors, we should not say this time is different. We know as market anchors, we should not say decoupling, because it didn't happen last time. But it looks like that. Our macros are good. Our macros are fine. That's not the case globally. Can you just parse whether we can continue to at least outperform outstandingly?
No, I do think that our macros are different. So there are two levels to that. The first is that the recovery from the pandemic is likely better than had been feared. And therefore, the pace at which the economy is operating right now is better than had been expected even 6 months back. The second is that from a medium-term perspective, there are several drivers of growth which did not exist or were much weaker in the previous cycles. So the most important being that the real estate inventory, the dwelling construction cycle is, I think, improving. I think the Indian participation in goods supply chains globally, there is a market share gain. So in electronics, in chemicals, in maybe even in apparel, in auto components. Now, the reason this matters is that even though the global goods supply chain is currently under a lot of stress, the market share gains are helping offset some of the impact even in the near term. And then you have significant improvements in infrastructure. So road freight is a lot easier to move now. And I think these kind of structural shifts matter a lot when you're thinking about the medium-term growth. But I think this bigger picture, are we going to be able to withstand a substantial global slowdown, is something that we should not overdo, in the sense that we will have an impact of the global goods slowdown. We have already seen that. We will have an impact of the slowdown in capital inflows. Remember that we are still a current account deficit country. So if global capital flows are de-risking, there will be a growth impact on our economy. And also remember that our critical services sector has not yet started to slow down. Remember that US unemployment is still at only 3.5%. And it is reasonable to assume that unemployment there will go up, and that will also be another headwind to the economy. So we need to close our balance of payments deficit. We also will be affected by the interest rates that we have been hiking for the last 4 or 5 months. And so I think the economy will slow from here, right? Okay. The point we make in a note published today is that it is slowing from a much higher level than had been feared, and we should be able to hold on to a 7% growth rate.
Okay. Well, I was coming to those questions as well, your numbers. But before that, we have not adequately parsed the global environment, especially its trend over the last couple of weeks. I mean, 4.6% on the US 2-year. If the risk-free rate gives you 4.6, what is the implication for countries like India?
So in the near term, this means obviously very bad things, especially if you're a capital importer, that the growth that you can sustain, the level of growth that you can sustain then starts to slow down, because you need capital to sustain that growth. And if your balance of payments goes into a very sharp deficit, there is clearly a headwind to growth. But also remember that the strength of the US dollar, not just because of the higher interest rates, is also a sign of de-risking, that people are much more comfortable holding the dollar than any other currency. And there is also, I would say, a very obvious short covering happening on the dollar. Remember, if you borrow in a currency that you are short that currency. So if several $trillion of dollar-based debt that exist on companies and individuals' balance sheets, if they panic and start settling them and not rolling them over, it increases the demand for dollars. So there is a cyclical element to this as well, which hopefully in the next 3 to 6 months, as we get more clarity on how the global macro is shaping up, will hopefully start to settle a bit as well.
Okay. Yeah, we are hoping that happens without any accident. UK brought us to the brink of an accident. One hopes policymakers would have learned their lesson and won't let it happen again. But let me come back to the numbers you were mentioning, that you expect GDP to come back to the 7% mark. I did speak to a lot of economists. The RBI is standing at 6.5%, and it is an outlier for FY24. The next best number I have is Morgan Stanley at 6.2, and almost everyone else is a little sub 6. What gives you the confidence? Are you confident of 7 as early as FY24?
No, I meant 7 after the slowdown.
Medium.
We haven't slowed yet. But in my assessment, our current growth rate is closer to 9, and I think if we slow, we'll slow from 9 to possibly 7. I'll tell you what is happening, right? For a forecaster, generally trend is your friend. There is a lot of predictability in how individuals, families, I would say businesses operate, right? So there is a force of habit. There are demographic shifts, like people tend to have babies at a certain age. They tend to retire at a certain age. So there is an element of predictability. And when a trend breaks, so when you see a trend line breaking, the forecasters then get into a lot of uncertainty. There is a challenge in how low are we versus the pre-pandemic path, and also what will be the trend growth after this disruption, right? Okay. Because these disruptions tend to disrupt the trend growth as well. And now I think in September quarter, we should be at a level where the base is not meaningfully distorted. Okay. June quarter June quarter last year was very, very terrifying.
Very bad, yeah.
But September, even on the CSO's numbers, which on a quarterly basis are actually not very reliable in my view, but on the CSO's numbers, we were about 11% below the pre-pandemic path back in September last year. And that was more or less the level at which they talked about for June 22 as well. Okay. So September should be a quarter where the base is not badly disrupted. So when we looked at a very broad range of indicators, auto sales of various types, rail freight, energy demand, energy demand 3-year CAGR is growing at 7%. Now, there is September 19, if you remember, we had some coal disruptions. Even if you adjust for that, we are well above 4% CAGR on energy demand. And that means the economy is doing well because energy efficiency continues to improve. So I think that the current growth rate is very well higher. Consensus is at 2% CAGR for September quarter. If you do a real measure, and the CSO can keep publishing what they do, but in the markets, people will respond to what companies are doing, and you see banks, right? They're not lending because they are reading the CSO's forecast. They are lending. Their senior management is letting their branch offices lend more because of the data they are seeing. It's so, like
Neelkanth, let me stop you there. I take your point entirely that there are problems with the NSO's numbers, and this once I wish that you are right and not the consensus. But I want to drag you back to Samvat and to the markets. How will it mean earnings will pan out? The numbers I read for Nifty EPS is something like 870, 815, 820 thereabouts, which is indicating more a 10-11% EPS growth for FY23. What are your numbers, and what would you look forward to in FY24 in terms of corporate earnings, whatever measure you want to use?
If I may say so, I don't think FY23 matters, other than for the market, that is, other than possibly setting a base for FY24. Because remember that when you're buying the market, or at least when I think about or advise people on whether to buy the market or not, you are buying for at least 12 months, right? You're not, there are people who make money on day trading. I don't think I have that skill. So I would rather look at, if I buy Nifty at 17,000, where will I be on price to earnings 1 year out? And I think that the 1 year out price to earnings is very likely to be sub 17. So as we think about 12-month forward earnings in September, October next year, we'll have half a year of FY24, half a year of FY25. I know it looks really far out and almost unforecastable, but you know what? That is what will drive the market. I mean, how FY24 and 25 earnings move, and I think that the 12-month forward, as we are sitting in September, October next year, will be upwards of 1,000, and therefore, I think that and there is a fair degree of resilience there. So if you see the very early season, early result season right now, but bank earnings are going up.
Absolutely.
And remember that the incremental EPS financials matter a lot.
Yeah, absolutely. Neelkanth, since I'm running out of time and I want to get this question in, isn't it time then to buy PSU banks? Would the alpha lie there?
I have some sympathy for that argument. We have been positive PSU banks and overweight PSU banks for a while now, but I'm still apprehensive, and perhaps this is why sometimes age can be a deterrent, of going too far down the quality curve among PSU banks.
Okay.
So we have a few PSU banks in our in the recommended list, and one in our model portfolio. So no, I think that at least the good quality ones we should definitely consider. The ones who are outside the, say, top 2-3 in terms of return on assets and past track record, I would still be a bit cautious on, though, but I can see why some people would find them interesting.
Okay. Thank you very much for those views. Neelkanth, out of time. Time is never enough when I'm speaking with you. And I do hope that this Samvat and the subsequent Samvats are as bright as you are telling us it will be. We have to take a break, and thereafter another market master joins us, Betty Subramaniam, the Chief Investment Officer at UTI AMC.